Let's go back to the stock market, for example, because when you hear about the 401k or the Roth IRA or retirement savings, you're hearing about the stock market. You're hearing about stocks that went up 250 times. You hear about someone who put $1,000 and years later, it's worth $250,000. You hear about the person that was putting away $500 per month and 20 years later, they had $1.5 million in their retirement savings so that they can retire comfortably. Today, you're hearing about the Trump accounts. Parents will be able to put $6,000 per year tax-free for their child. So when their child turns 18 or 21, they will have a step into the future that their parents never had. Now, I'm not selling you stock. I'm talking about what the credit cards are costing you. It's costing you your future and your family's future. The banks that you're paying, they're making a fortune off stocks. But what if you were the one who invested in these in 2008 instead of paying credit card interest since then? How would your life be different? But here's the real issue. You never even had the $1,000 available to take the opportunity. You never even had the $500 to put away every month towards your retirement. Why? Because your extra money isn't sitting in your savings, it's going towards minimum payments. And I call it the minimum payment tax. Not a government tax, it's a financial system tax. It's the silent drain that happens every single month. You pay $500, $900, $1,100, $1,400, but it doesn't even touch the principal, so your balances stay the same. It's just feeding interest. The banks are taking your money that you're paying as interest, and they invest that into the stock market, and they keep the additional growth of the market, which gives them more money to loan to you, to keep you stuck making minimum payments. And they just get bigger and bigger while your anxiety and stress grows larger and larger. It's a vicious cycle. And here's the part most people don't even realize. It's not even tax deductible. So if you're making money on payroll, if you are a W-2 earner, credit card interest on purchases is not deductible. That means you pay 22 to 29% interest. You don't reduce your taxable income. You absorb 100% of the cost. Even TurboTax explains it clearly on their site. Personal credit card interest is not deductible unless it's directly tied to legitimate business expenses. So the interest you're paying is fully after-tax money. That's what makes this so expensive.